Hello there. If you're a digital nomad, a remote worker, or really anyone with ties to the UK, you need to listen up. The year 2026 is about to bring in some of the biggest tax changes we've seen in a generation. Seriously, the old rulebook is being thrown out. To help you get your head around what's coming, the expert tax advisors at My Tax Accountant have put together this essential guide. So let's get into it. Right, let's kick things off with a number that should really grab your attention. If you're working abroad and want to protect your right to a full UK state pension, well, the cost is about to absolutely skyrocket. The annual voluntary payment you make is jumping from a pretty manageable £182 all the way up to £957. That is a massive increase, and honestly, it's a change that's going to catch a lot of people out. So let's just ask that question directly. Is your ability to secure a full UK state pension really about to become over 400% more expensive? Well, for a huge number of people, the answer is a simple and resounding yes. And believe me, this is just the tip of the iceberg when it comes to the big shifts happening in 2026. This catches so many people by surprise, so it's absolutely crucial to be prepared. Now, all this information comes straight from the team at My Tax Accountant, who are one of the UK's most trusted accounting firms. Their expert tax advisors have put this guide together specifically to help internationally mobile workers just like you get ready for what's on the horizon. Okay, so here's what we're going to cover. First, we'll look at the brand new tax playbook and why the old non-dom era is over. Then, a huge new opportunity, your 4-year tax-free window. We'll then break down that state pension cliff edge we just talked about, cover HMRC's new digital rules, look at the growing risks for companies hiring remote UK staff, and we'll finish up with a really clear action plan for you. Right, the main thing you need to grasp is this. From 2026, the rules of the game are fundamentally changing. The UK tax system is getting rid of old, really complicated ideas like domicile, that concept of where your heart's home is. It was messy. The new system just sweeps all that away. Instead, your tax status is going to be based on a much simpler factor, your tax residency. It's a completely new playbook, and understanding it is absolutely key. Now, this new playbook actually creates a pretty amazing new opportunity. It's a 4-year tax-free window for people arriving or returning to the UK. It's called the Foreign Income and Gains Regime, or the FIG regime for short. You'll definitely want to hear this part, as it could be incredibly valuable for you. And the difference between the old and new way is just stark. The old remittance basis was an absolute minefield. You were taxed on any foreign money you brought into the UK, which meant a total nightmare of trucking funds. The new FIG regime, on the other hand, is refreshingly simple. For your first 4 years of UK residency, you can bring your foreign income and gains here completely tax-free. And it's open to any qualifying new resident, not just those old-school non-doms. So how do you qualify? It's a nice, clear 3-step process. First, you have to have been non-UK resident for at least 10 years in a row. Second, you just become a UK tax resident. And third, you have to actively make a claim for it on your tax return. So picture this. Anya is a software developer who's been working in Canada for 12 years. If she moves back to the UK in 2026, she can use this regime to bring all her savings and investment income to the UK, totally tax-free, for 4 full years. It's a game changer. But, and this is a big but, here's a crucial tip from My Tax Accountant. When you claim the FIG regime for a tax year, you give up your tax-free personal allowance. That's the £12,570 you can normally earn before paying any tax. So you absolutely must do the maths. Let's make this simple. Imagine you save £2,000 in tax on foreign income by using the FIG regime. Sounds great, right? But losing your personal allowance means you'll pay 20% tax on that chunk of your UK income, which works out to an extra £2,514 in tax. You'd actually be worse off. It's a critical calculation to make. It's not an automatic win for everyone. Now, for those of you who are already expats, there's a little window of opportunity opening up. If you have foreign income you earned before April 2025 that you've kept offshore for 2 years only, that's the 25, 26, and 26, 27 tax years, you can bring it to the UK and pay a one-off tax charge of just 12%. It's a pretty significant discount, designed to get people to bring that money back into the country. Okay, let's switch gears and go back to the state pension. We've gone from a big opportunity to a really serious risk. This is the change that requires your immediate attention if you're working abroad but have a UK work history. Stay with me here. This next point affects thousands of expats, and you really will want to understand the implications. So, did you know about this? From April 6, 2026, The cheap, simple way for people abroad to make voluntary national insurance contributions, that's the Class 2 contributions, is being completely scrapped, abolished. For decades, this has been the go-to for expats to top up their pension. The government says it's about simplifying the system, but for expats, the side effect is this enormous price hike. And this table really lays out the full impact. Before April 2026, you could pay Class 2 for about £182 a year, so long as you had a basic 3-year link to the UK. After April 2026, your only choice is the much more expensive Class 3. The cost leaps to £957 and the eligibility rules get way tougher. You'll now need a 10-year link to the UK. Think of someone like David, a freelance designer who's been in Spain for 5 years. He might now find himself completely locked out from making any future contributions at all. Let's make this dead simple. Here are the key dates to put in your diary right now. April 6th, 2026. That's when the new expensive rules kick in. July 10th, that is the absolute final deadline for making your final payment under the old, cheap system. After that date, HMRC is going to start writing to people to explain their new and much more limited options. All right, let's break this down even more and look at the new admin you'll have to deal with. From 2026, it's not just the tax you pay that's changing, it's how you report your income. This is the long-awaited arrival of Making Tax Digital, or MTD, for the self-employed and for landlords. So, what on earth is Making Tax Digital for income tax? Well, it's a new mandatory system from HMRC. If you're self-employed or a landlord and your total income from all that is over £50,000 a year, you will be required by law to keep all your records digitally. And you'll have to send tax updates to HMRC every 3 months using special software. The old annual tax return is being replaced by a quarterly process. So what does this actually mean for you day to day? Well, you've got 4 new duties. 1. Every single business transaction has to be recorded digitally. No more shoeboxes full of receipts. 2. You must use MTD-compatible software. A normal spreadsheet just won't cut it anymore. 3. You'll have to send a summary of your income and expenses to HMRC every single quarter. And 4. At the end of the year, you'll submit a final declaration to tie it all up. Okay, so far we focused on you as an individual. But what if you're working for a foreign company, or what if you are that company? The global shift to remote work has put this issue squarely in HMRC's sights, and this next change is even more important for businesses. Now here is where a lot of businesses get into serious trouble. If you're an overseas company and you hire someone based in the UK, you risk creating what's called a permanent establishment. This is a huge one. It's basically a legal tripwire that means your employee's presence in the UK could make your entire company liable for UK corporation tax. On top of that, you can't just pay them as a freelancer. HMRC will expect you to run a full UK payroll, or PAYE system. This also means correctly handling national insurance for both of you, and finally, you are legally required to enroll your UK employee into a workplace pension. Ignoring any of this can lead to massive penalties. It's a real minefield of compliance. Okay, we've covered a lot of ground, from a brand new tax-free window to a pension cliff edge and digital reporting. So what should you actually do about it all? Let's pull everything together into a clear, actionable plan. These are the steps you should really be thinking about taking right now. Here is your checklist for 2026. First, go online to the government website and review your national insurance record immediately. See exactly where you stand. Second, if you're planning a move to the UK, assess if you're eligible for that 4-year FIG regime. Third, if you're staying abroad, you absolutely must start budgeting for that huge increase in pension contribution costs. Fourth, if you're self-employed with income over £50,000, start researching MTD-compatible software now, not later. And finally, if your business employs staff in the UK, please get professional advice on that permanent establishment risk. Now, before we finish, an important disclaimer. This information is intended for general guidance, and it's based on the rules as we understand them in January 2026. It is not a substitute for personal financial advice, and you must remember that tax rules can and often do change. The most important takeaway is that these changes are complex, and how they affect you will depend entirely on your own personal situation. To get expert, personalized advice and really take control of your tax situation, you should speak to a professional. You can contact the team at My Tax Accountant directly on 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk. And finally, for more essential updates just like this one, don't forget to subscribe to the My Tax Accountant YouTube channel. Thanks so much for watching.